Hello everyone, welcome to the fourth and last lecture of AS10 revised, that is property, plant and equipment. Okay, in the last lecture we studied the practical questions based on recognition of assets and valuation of its cost. How to find the cost of acquired asset as well as self-constructed assets. We studied in detail which directly attributable costs are to be taken in consideration, which are not directly attributable costs, etc. Now today we proceed further with the same. Take out your study material, and after the cost model you'll find exchange of assets. Now this is quite obvious. See, exchange of assets do take place in regular life. You all would have experienced it. How many of you might be having old car used for, that is used for 5 years, 7 years, 10 years, then you buy a new car. So normally first thing what you do is when you go for buying a new car is you ask them, will you take my old car in exchange? Obviously the answer is yes. They have their own valuers, they have their own technicians who will technically find out the value of your car and adjust that difference against the value of new car. So here in accounting standard 10 they prescribe when exchange of assets take place, what is to be done. Look at it. AS 10 specifies that exchange of items of PPE, regardless of whether assets are similar, are measured at fair value. Means regardless of whether assets are similar. Here the example which I gave you, the assets were similar. You were giving the old car and buying against that a new car only. But here they said this standard applies regardless of whether the assets are similar. So even if you exchange, let us say you give your old cupboard or furniture and against that you buy a new television, then that exchange is also covered over here. Any kind of exchange is covered over here. Normally we have such dissimilar assets in exchange when you buy any assets for consideration other than cash. So if a company buys, let us say, a plant and machinery, and company gives its own shares instead of paying the money in cash, company gives its own shares as the value of consideration of that plant and machinery. Again, two assets are being exchanged. You are giving shares, you are not giving cash, but two assets are exchanged. Shares, one asset is going out, and plant and machinery, other asset is coming in. Here the assets are not similar. Here also exchange of assets rule of AS10 will apply. So look at it once again. AS10 specifies that exchange of items of PPE, regardless of whether assets are similar, are measured at fair value unless the exchange transaction lacks commercial substance. Commercial substance means we will apply or find the cost at fair value unless the exchange transaction lacks commercial substance. Commercial substance means the asset which you are acquiring is going to result in flow of economic benefits to the enterprise. Then we say it has commercial substance. Commercial means monetary value, monetary substance. Okay, I repeat, the asset which you are acquiring is going to result in economic benefits. Then you say that the asset has commercial substance. If the asset which you are acquiring is not going to give you any economic benefits, then that doesn't have commercial substance and that won't be measured at fair value. So here they say it will be measured at fair value unless means unless the exchange transaction lacks commercial substance. If it has commercial substance, there is a condition, then only it will be measured at fair value of the asset acquired. B, the fair value of neither of the assets exchanged can be measured reliably. Okay, neither you know the fair value of the asset given, nor you know the fair value of the asset acquired, then obviously you cannot measure it at the fair value. So generally the asset acquired in exchange is measured at the fair value. And what are the two conditions that it should be measured at fair value? It must have commercial substance and the fair value must be available. If the fair value of neither of the assets is available, you cannot measure it at fair value. So if the acquired item is not measured at fair value, why not measured at fair value? Because of the above AB conditions not satisfied. It is not measured at fair value means either it doesn't have commercial substance or the fair value is not ascertainable or both the situations apply. Then its cost is measured at the carrying amount of the assets given up. Carrying amount means book value. All of you underline carrying amount and write book value of the assets given up. So at least book value, the value of the asset given will be available in your books, in your balance sheet. Then the asset acquired will be measured at the book value of the asset which you have given, the value in your balance sheet of the assets which you have given. Okay, if the acquired asset or the acquired item is not measured at fair value because of A and B reasons above, then whatever asset you are giving, the book value of that asset would be taken as the value of the new asset. Okay. Whether an exchange transaction has commercial substance depends on the extent to which the reporting entity's future cash flows are expected to change as a result of transaction. I just explained you right now, commercial substance means you are going to get economic benefits. If the expected cash flows after the exchange differ from what would have been expended without this occurring, the exchange has commercial substance and is to be accounted at for the fair value. Means the expected cash flows differ from what would have been expended, means they should be more than what you are spending. The expected benefit from the asset should be more than what the value of the asset what you are buying. Then you can say it has commercial substance and it will be measured at the fair value. If the transaction does not have commercial substance, means the expected cash flows are not more than the amount you are spending on it, or the fair value of neither the asset received nor the asset given can be measured reliably at the top, A and B conditions are not satisfied, then the asset acquired is valued at carrying amount. We discussed already below that if the fair value is not ascertainable, the carrying amount of the asset given up in cash or cash equivalent, this is often referred to as the boot. Okay, if neither of the assets value is available, it is called as boot. This can be asked in MCQ. Underline this. What is boot? Neither the assets given value is available fair value nor the assets acquired fair value is available. Then we take the book value of the asset given as the fair value of the new asset acquired. See, I'll give you a few examples so that you understand it. How is it possible that the asset given's value is also not available and the assets acquired value is also not available? Okay. Suppose you have a house or a flat or a bungalow or any kind of residential or commercial property in Baroda. Your brother or relative has a similar kind of property in Rajkot. Now you both decide, you both are actually changing your workplace. Let us say that you are shifting to Rajkot due to some reasons and he is shifting to Baroda due to some reasons, and you are brothers. So you both decide that you come and stay over here, this house becomes yours in Baroda, and you go and stay in Rajkot, that Rajkot, your brother's house becomes yours. Okay, so now what happens in your business? When in business such a thing takes place, here you are not finding its market value. He is your brother. You are not expecting any monetary consideration from him. And you have not even dictated any terms or discussed that this difference amount you have to pay or I have to pay. Here what happens? Suppose in your books, your flat of Baroda is shown at, let us say, or house of Baroda is shown at 30 lakhs. When you go to shift to Rajkot, now in your books, you don't have Baroda house, you have Rajkot house. The value will remain same. We'll just change the name of the asset. From Baroda house, it will become Rajkot house. The value will remain same, that is 30 lakhs. Book value of the asset given. Same way it will happen for your brother also. Okay, we are not discussing only what value we are going to pay to each other. If in his books, the value of that house is 35 lakhs, Rajkot house, he will simply replace Rajkot house with Baroda house name. The value he will keep same, 35 lakhs. So this is called when the fair value of the asset given is also not discussed and when the fair value of asset acquired is also not discussed or negotiated. Then you take the carrying amount of the asset given itself as the fair value of the new asset. You just change the name of the asset in your balance sheet on asset side. Okay, so this is the example. I hope you all understand this portion. This type of transaction is called boot. It can be asked in MCQs. Okay, to understand this provisions in detail, two more examples we take up. Is there in your study material also. Induga Limited exchanges car with a book value of 13,000. The car which you are giving has a book value carrying amount of 30,000 in your books, having a fair value of 13,250. The car which you are giving, its fair value is also ascertainable, that is 13,250. So here that boot doesn't come. Boot comes when fair value of asset given as well as acquired is not being known. Here the fair value of the asset given is known, 13,250. Boot will not come. Now you are giving your car of 13,000 whose fair value is 13,250. For cash of rupees 150 means you are giving that car and also you are paying 150 rupees further. And car Y. Against car Y means you are buying car Y which has a fair value of 13,100. Now you are buying car Y that is 13,100. You are giving your car X which is having a book value of 13,000. Further you are paying cash also rupees 250. Why? Because the fair value is 13,250. Against which car Y is acquired whose fair value is 13,100. Now first of all the transaction lacks commercial substance. Why? I discussed commercial substance means the expected cash flows should be more or different. Should be more or different from the amount expended. Here the car of 13,000 is given, car of almost 13,000 is acquired. Means I am sure the expected cash flows are not going to differ. They are going to almost remain same. So the transaction lacks commercial substance as company's cash flows are not expected to change as a result of the exchange. It is in the same position as it was before the transaction because cars are also of almost the same value. So here it lacks commercial substance means will not record it at fair value. What did we discuss? If any of the condition is not satisfied, you will not record it fair value. What will you record it at? Here you will record it at the book value of the asset given. So the Induga Limited recognizes the assets received at the book value of car given. Which is the car given? X. You have given the car X for what amount? 13,000. Further, 150 rupees you are receiving along with car Y. So what is the net benefit you are going to get? 13,000 minus 150, 12,850. Okay. So therefore it recognizes cash of rupees 150 and car Y as make it property, plant and equipment with a carrying value of 12,850. Why 12,850? Because out of 13,000 you already received cash of 150 and a car of 13,100. Two things you are receiving. So you are giving car of 13,000, you are getting cash of 150 means the value of new car we will consider 12,850. Why we don't take the fair value? Because it lacks commercial substance. So if it lacks commercial substance, fair value cannot be taken. Then what is to be taken? The carrying amount, book value of the asset given up. What is the book value of car X given up? 13,000. Against that you receive 250 rupees in cash plus a new car. So 250 rupees what you receive in cash, you minus. Means in asset side cash 250 you will show separately and car 12,850 you will show separately. So total book value 13,000 will remain as it is. I hope everyone got this point. Lacking of commercial substance. We don't take fair value. We take book value of the asset given. These all can be asked in MCQs. Okay. Example 8. J&N Company exchanges an automobile with a carrying value of 2,500 with SN Company. You are giving your automobile means again car or vehicle anything whose carrying value, book value in the books is 2,500 for a tolling machine. Okay, means maybe that car you were using to pull the assets from one place to another. Against that you buy a tolling machine only, you don't want a car. Tolling machine with a fair market value of 3,200. Now here in previous example you gave car you took car against that. Okay, and fair value was also ascertainable, right? Here you are giving automobile but exchange against that you are taking tolling machine whose fair market value is known 3,200. First of all, no boot is exchanged in this transaction. Means boot means what did I tell you? Neither the asset given's fair value is available nor the assets acquired fair value is available. Here the assets acquired fair market value 3,200 is ascertainable, so there is no boot. And it has commercial substance also. Why? You gave automobile and particularly you bought tolling machine, so its economic cash flows or benefits are going to differ from the asset what you have given up. So here commercial substance is also there. Okay, and fair market value is also ascertainable. So we will record the asset at fair value, fair market value. So the fair value of automobile is not readily determinable, but the fair value of the asset acquired is determinable. So in this case, J&N Company has recognized a gain. Means you will record the new machine at 3,200. You are giving old machine of 2,500, so 700 is your gain. On the exchange, and gain should be included in the determination of net income. The entry to record the transaction would be as follows. So new asset you will record at its fair value because both the conditions are satisfied. Machine account debit with 3,200. Automobile which is going out, its book value is 2,500, credit what goes out to automobile 2,500, and profit of 700 you'll record as to gain on exchange of automobiles and credit that to P&L account. Okay, so in this example 7 we understood that it lacked commercial substance as well as fair values were not readily ascertainable, and basically it lacked commercial substance, so we could not take it at fair value. In example 8, commercial substance is also there, fair values are also available, so we took the fair value of the new tooling machine, that is 3,200, and 700 of income we transferred to profit and loss account. I hope you all understood this exchange of assets point over here. Further, look at the page 29 of your study material. There is one more example on exchange which we will solve in your notebooks. Take out your notebooks. Yesterday 5 examples we had already done. Until 5 we have already done. So this 6 now you'll write in your notebook. Look at page 29. On March 31, 2019, winning company traded in an old machine having a carrying amount, means book value of 16,800, and you also paid a cash difference of 6,000 for a new machine having a total cash price of 20,500. First of all, new machine's cash price is 20,500. So the fair value of new machine is available, that is 20,500. You are giving cash 6,000 and your old machine also 16,800. It is going to increase your economic benefits. So it has commercial substance also. Okay, it has commercial substance also, and fair value of new machine 20,500 is also ascertainable. So we will record the new machine at 20,500. Now against that what you are giving, 16,800 plus 6,000, 22,800. So on March 31, 2019, what amount of loss should winning company recognize on this exchange? Like in the previous example we took up, there was a profit, here there is a loss. There we gave 2,500 of consideration and got 3,200. Here we are giving 16,800 and 6,000, 22,800, and against that we are getting 20,500 of asset only. So difference 2,300 is our loss. Okay, so this has commercial substance also because new machine we are buying against an old machine, so economic cash flows are going to differ. Secondly, fair value of new machine is also ascertainable, 20,500. So new machine we will record at the fair value 20,500, and against that what we are paying is 16,800 plus 6,000, 22,800. So loss of 2,300 will be recorded in the books of accounts. Write down in your notebooks. Carrying amount of old machine 16,800, cash difference paid 6,000, total monetary value given up is 22,800, against which the fair value of new machine acquired is 20,500. So loss to be recognized in P&L account is 2,300. Okay, you can pause the video and note down this solution in your notebook. These all things can be asked in MCQs. They can ask you the loss, they'll give you 2-3 amounts, you have to select one of the correct options. Further, measurement of cost. Now you'll ask a question that, sir, we already studied cost in the last lecture, then what is this measurement of cost again? Certain points are to be understood regarding measurement of cost later on. What we studied in the past lectures was initial measurement of cost. Now we are talking about subsequent things. What all things are to be taken into consideration? The cost of an item of PPE is always the cash price equivalent at the recognition date. Means you have to keep this in mind, that suppose you buy any asset on installment system. Let us say you buy a car on EMI system. The car is of 9 lakh rupees and you are paying EMI of, let us say, 1 lakh for 10 years. So basically you are going to pay 1 lakh into 10 lakhs. Now the question arises, the car should be recorded in the balance sheet at 9 lakhs or 10 lakhs, because you are going to pay 10 lakhs. You will record 9 lakhs only. You are paying in installments, that's why you are paying more in the form of interest. If you would have paid full amount there and there itself, means full amount in cash. Cash price means what? If full amount is paid in cash, then what is the cash price of that car? 9 lakh rupees. On the spot if you pay cash, what is the cash price of that car? 9 lakh rupees. 9 lakh rupees only you will record as the value of the car in your balance sheet. 1 lakh what you are paying extra over the years, as in when you pay that in the form of interest, you will debit that to P&L account. So this is a new point to study over here. If the payment is deferred, make it D, okay, it's correct, DE, not DI, DE. DEFERRED, deferred means paid in installment beyond the normal credit terms, the difference between the cash price equivalent and the total payment, that is that 9 lakhs and 10 lakhs, is recognized as interest over the period of credit unless such interest is capitalized in accordance with AS 16 we studied. AS 16 borrowing cost we studied yesterday also. In some cases, pre-construction period borrowing cost is capitalized and added in the cost of asset. Unless it is that situation, interest will be shown separately in P&L account on debit side. Now, second situation. So, first one is when you buy in hire purchase or installment system. Second, the cost of an item of PPE held by lessee. Now, lease accounting we have already done AS 19 in detail. So, cost of asset acquired under lease accounting standard would be under a finance lease is determined in accordance with AS 19. So, that we already studied in AS 19 in detail. Here, AS 10 will not intervene in between. If an asset is acquired under a lease agreement, then AS 19 will apply for the same. Cost of bearer plants. Now, bearer plants we studied, you remember in the first lecture, what are bearer plants? Come on, try to recollect. I told you, bear word comes where? Okay, I told you that you will bear the fruits of your hard work. This example I gave. So, remember that only. Generally, fruits, trees are called bearer plants. Okay, the examples we have seen, apple trees, orange orchards, mango trees, orchards, etc. So, they are all bearer plants. Bearer plants are accounted for in the same way as self-constructed items of property, plant and equipment. Means at the same way, same rules are applied. Whatever money you incur in setting up that bearer plant will be considered as its cost before they are in the location and condition necessary to be capable of operating in the manner intended by the management. So in bearer plants also you have to set up a land, you have to sow the seeds of that trees, you have to nurture it, you have to maintain it. So all the expenses incurred until the tree is grown, that is like self-constructed asset. You have made that tree grown. So all that expenses until it is grown and starts bearing the fruits will be treated as the cost of those bearer plants. Subsequent costs. Now we come to subsequent. Subsequent means asset is acquired in past. In future, if you incur any expense, how to deal with that? The issue is whether subsequent expenditure is capital expenditure, which would be recorded in the balance sheet, or revenue expenditure that would be taken to profit or loss statement. See, very simple rule is to be applied. Okay, go by the difference in revenue and capital expenditure. Revenue is something routine, day to day, every day, every month. It's recurring, again and again it occurs. So if any expense related to your asset, property, plant and equipment you are going to or expecting to incur again and again, regular repairs, maintenance, servicing, etc., that you would debit to P&L account. And if you find that you are incurring any cost subsequently to the asset, you are replacing some part of the asset, you are putting some new asset, replacing the old one, which is going to increase the life of that asset. That is a major expenditure that you would capitalize and add it in the value of asset in balance sheet. Okay. So for example, air condition, if I talk about, if you do regular cleaning, maintenance, and you pay annual maintenance contract amount, etc., that is a revenue expenditure that you would debit to P&L account. But if you change the compressor because the cooling is coming less, then that changing of compressor is going to increase the life of your air condition straight away by next 5-7 years. It is a major expenditure that you will capitalize and add in the value of air condition on the asset side. So an entity does not recognize in the carrying amount, means in the book value on the asset side of an item of PPE, the cost of day-to-day servicing of the item. Rather, these costs are recognized in profit or loss as incurred. Costs of day-to-day servicing are primarily the cost of labors and consumables and may include the cost of small parts. So in the AC, small part switch is replaced. In the AC, small part filter is replaced. These are considered small expenses, not major ones. These you'll debit to P&L account. The purpose of these expenditures is often described as for the repairs and maintenance of the item of property, plant and equipment. So these are debited to P&L account directly. To qualify for capitalization, the cost must be associated with incremental benefit. I told you, for example, modification of the asset may be made to extend its useful life. Just now I told you the example, you change the compressor of the asset, you're modifying that asset, you're putting the new compressor in the machine. So that is definitely going to increase the useful life of the asset as well as its efficiency. So modification to the assets made to extend its useful life or to increase the capacity would be capitalized. Similarly, if the expenditure results in an improvement improvement in quality of output, or results in saving the cost, it will qualify for capitalization. Okay, so what do we conclude? That if the expenditure is day-to-day routine and small amount, you will treat it as revenue expenditure, any subsequent cost. If the expenditure is major amount, big amount, any modification in asset is done, it is going to increase the useful life of the asset, it is going to increase the economic benefits from the asset, then that expenditure would be capitalized. Parts replacement. If you replace any part, okay, just now that compressor example I already gave you, but in detail, if you replace any part, how it is to be dealt with. Let us see that. Some items, example aircrafts, oh my god, aircraft, so huge expense, ships, gas tube lines, etc. are series of linked parts which require regular replacement at different intervals and so have different useful lives also. So in aircrafts, you have to regularly keep on replacing. In ships also, its parts, and they all have their different useful life. So every part you replace is capitalized because it's a major amount. It's a big amount. Now you may ask a question, sir, aircraft itself is of hundreds of crores of rupees. So of course its parts are going to be major only, but its parts have its useful life also. If you replace a small part in the aircraft, engine, batteries, etc., they have their own useful life of 4 years, 5 years, 7 years, after which you will replace them again. So they all small parts are treated as different assets in our books of accounts. The cost of such replacement is capitalized if the recognition criteria are met. And the carrying amount means book value of replacement parts, old parts is derecognized. Old parts you remove, new derecognize means you remove from the asset side, and the difference amount, profit or loss, is debited to P&L account, and new value of the new part is taken again in the books of accounts. Major inspection and overhaul means repairing costs. I repeat, overhaul means repairing costs. Performing regular major inspection for faults. Now see, again, regular major inspection may be required regardless of whether parts of items are replaced. May be a condition to continuing to operate an item of PPE, example, an aircraft. So these are also capitalized. Now you may say, sir, inspection is done again and again. It is going to be done every year. Isn't it revenue? No, because that inspection is necessary for the smooth working of that equipment. Okay, example, if you don't, this aircraft, if you don't inspect again and again and it results in major accident, it would be very fatal for your business. So that major inspection costs, means inspection which is done time to time, involves huge costs. That is to be capitalized. One more example I'll give you. In big multiplexes, malls, etc., major inspection of escalators and lift is done again and again, because too much of crowd uses those things again and again, and if there is any fault, it may result in harm to large number of crowd at a point of time. These inspections are major costs and they are generally capitalized and added in the value of that asset, because without this major inspections you cannot continue to use that asset in regular operation. Okay, so one more example I gave you of lift over here. Performing regular major inspections for faults regardless of whether parts of items are replaced may be a condition of continuing to operate an item of PPE. The cost of each major inspection performed is recognized in the carrying amount, that is capitalized as a replacement if the recognition criteria are satisfied, and any remaining carrying amount or the cost of previous inspection as distinct from the physical parts is derecognized, same like part replacement. In short, major inspection costs are to be added in the value of asset on the asset side. Further, changes in existing, decommissioning, restoration and other liabilities. Now understand these things. First of all, what is decommissioning? Withdrawing back. What is decommissioning? Suppose you buy or you take an asset on lease, property on lease. In that you put some furniture of 2-3 lakh rupees, and the condition of the person giving you the property on lease is that once the lease period is over, you take back the furniture with you. I want my place as it is, blank, vacant. So what will you do? You will take back that furniture with you. That is withdraw the furniture. That is called decommissioning. Restoration, dismantling, we already discussed. If you have constructed any walls, etc., he may allow you temporarily, but then he says, when you give it back to me, I want it as it is. So that dismantling is called restoration. And changes in other liabilities. Now when are changes in other liabilities possible? Generally, they are possible when you import the asset from other countries. Because when you import the other asset from other countries, then you pay in foreign currency. And if you are going to pay the money in installments, then in future, as the value of foreign exchange changes, your liability also changes. Maybe if the foreign currency becomes costlier against rupee, then in future your liability will increase. And in future, if the foreign currency becomes cheaper than rupee, then your liability will decrease. So how to account for these changes? Let us see. The cost of property, plant and equipment may undergo changes subsequent to its acquisition or construction on account of first change in liabilities. I gave you the example, change in liabilities generally happen when we import the asset from other countries. Because of change in the foreign exchange rate, your liabilities will also change. Price adjustments again related to import from other countries, because price adjustments may take place by the other countries' people in future. Changes in duties, this also happens. Suppose you buy an asset where the money you pay in installments, presently the GST rate of that is 18%. In future, it might be possible that from 18% it becomes 27%, or maybe it becomes 5% also. So whatever pending money is to be paid, on that the duty will change, and accordingly your liability will also change. So in which situation they are explaining you the changes are possible. Changes in liabilities may be possible, price adjustments may be possible, duties may be possible. So the cost of property will undergo a change. Because of all these things, the cost of property will also change. So if suppose you import an asset or machinery of $1 lakh, presently the rate of dollar is 70 rupees, means the cost of machinery is 70 lakhs. After 1 year, let us say $80,000 are pending, and from 70 rupees it becomes 75 rupees. So now your liability of $80,000 increases by 5 rupees. That is 4 lakh rupees, 80,000 into 5, 4 lakh. So in your books of accounts also, you will increase the value of asset by 4 lakhs as well as liability by 4 lakhs. In the balance sheet, your liability increases by 4 lakhs. So asset side, assets value also you will increase by 4 lakhs. This is how we have to change the value of asset in future. Similarly, we have to change it for price adjustments, and similarly we have to change it for change in duties also. From 18%, if your GST becomes 5%, you will decrease the liability also and assets cost also. From 18 it becomes 27%, you will increase your tax also, and you will increase your asset value also. How further the changes are possible? Changes in initial estimates of amount provided for dismantling. See, we discussed you have to estimate what amount would you incur to decommission, dismantle and restore the property in future. Now that may undergo a change, because removing, restoration and similar factors included in the cost of the asset are going to be incurred in future. So presently, suppose you assume, I give you an example of this mobile towers. You have seen that mobile towers are installed on the terraces of buildings. Now the builder who has given this terrace on rent for installing the mobile tower, he may say that the terrace is given for 10 years. After 10 years, I want the terrace as it is. So what happens? The company, let us say Airtel, Idea, Vodafone, whichever company is installing its tower, they estimate the cost in advance that after 10 years, removing that tower from that place will cost, let us say, 2 lakh rupees. But actually after 10 years, it did not cost 2 lakh rupees. Or after 5 years, you come to know that it may not cost 2 lakh rupees, but 3 lakh rupees, because the things have, the scenarios and economic and political situations have all changed. So because of those factors, the price is also going to change. So immediately in your books of accounts, you have to increase it by 1 lakh. As soon as you come to know that this cost of replacing or restoring or removing the things is going to increase, in your books of accounts, you'll increase the value of your asset also. I hope you understand this. Next, if the related asset is measured using cost model, there are two models we can use, cost model and revaluation model. So if the related asset is measured using cost model, what points we have to consider? Changes in the liability should be added or deducted from the cost of the related asset in the current period. Okay, so any change in the liability we discussed in the previous slide, if it is increasing, it should be added in the cost. If it is decreasing, it should be deducted from the cost. The amount deducted from the cost should not exceed its carrying amount, obviously. If the book value itself is 10,000 and liability is decreasing by 15,000, you cannot decrease it by 15,000 and make it minus 5,000. So if a decrease in liability exceeds the carrying amount, book value of the asset, the excess should be recognized immediately in the statement of profit and loss. It will be considered as your liability is decreasing, means your profit. So if your liability is decreasing by 15,000, decrease it by 15,000. Then your asset is decreasing only by 10,000. So remaining 5,000 you recognize in P&L account immediately. If the adjustment results in an addition to the cost of an asset, then the enterprise should consider whether this is an indication that the new carrying amount of the asset may not be fully recoverable. So suppose your liability, I told you that value of machine because of 5 rupees increase in dollar price, $80,000 spending becomes 80,000 into 5, 4 lakhs. So asset side, you're also going to increase it by 4 lakhs. But you see, suppose in the books of accounts, your machinery is valuing 50 lakhs. Now you increase it by 4 lakhs, 54 lakhs. You see, first of all, value it. If you try to sell it, then would you be able to recover 54 lakhs from that? If the answer is yes, you increase it by 4 lakhs. If the answer is no, then you don't increase it by 4 lakhs. 4 lakhs you recognize in P&L account. So once again, look at it. If the adjustment results in addition to the cost of an asset, the enterprise should consider whether this is an indication that the new carrying amount of asset may not be fully recoverable. Means that 4 lakhs what you are increasing may not be recoverable. If it is such an indication, the enterprise should test the asset for impairment. Impairment means the value is much less than the book values. Okay, a kind of scrap, written off is called impairment. Then it should test the asset for impairment by estimating its recoverable amount and should account for any impairment loss in accordance with AS 28. For impairment, there is a different accounting standard, AS 28. That is to be taken in consideration. If the related asset is measured using the revaluation model, revaluation model means subsequently you revalue the assets and you feel that balance sheet must show the correct financial position, true and fair financial position. So you'll keep on revaluing the assets and you'll show the assets at not the cost less depreciation but the revalued amount. Here what will you do? The changes in liability after the revaluation surplus or deficit previously recognized on the asset. Means if in past you have already recorded any revaluation surplus or deficit, that should be first taken in consideration before you revalue it again. So it's a simple logic. Okay. First understand what I'm explaining, then we read what is written. So if you are clear with what I'm explaining, reading is just a formality. Suppose in past you have revalued it upwards, means the revaluation of asset is done at a value higher than the book value. Let us say in the value the books is 1 lakh, you revalue 1,15,000. In past, if you have revalued upward, first time you have revalued upward. Okay, first time you have revalued upward. That 15,000 will be increased in the value of assets and it will be credited to revaluation reserve account or revaluation surplus account. Okay, either you call it as revaluation reserve or you call it as revaluation surplus. So 15,000 the entry would be machine account debit to revaluation reserve account. Asset side machines value will increase, liability side revaluation reserve will increase. First time I am talking about. In past it is revalued upward. First time in past it is revalued down. Suppose 15,000 less is the value of asset. Then you debit that to P&L account. Means just now what we did, machinery to revaluation reserve, now it's going down. So machinery will be credited and P&L account will be debited. So in that situation, what entry will you pass if the 15,000 revaluation is done less? First time in past it is done less. Profit and loss account debit to revaluation, to machinery account 15,000. Once again, first time revalued upward, you transfer to revaluation reserve. First time revalued downward, you debit to profit and loss account. Now in future, you again revalue it. So again two things are possible, it may be up or it may be down. Now in future when the revaluation goes upward, let us say in future again it goes up by 10,000. In past, if we have already revalued upward, then same treatment. That 10,000 you again transfer to revaluation reserve. Okay. But in past, if we had revalued down 15,000 down and now you are revaluing it up 10,000, then what was the amount we credited debited to P&L account because it was revalued down 15,000? To that extent you credit P&L account only. If you are revaluing upward and it is going beyond 15,000, then extra amount you credit to revaluation reserve. So in past 15,000 going down was debited to P&L account. In future up till 15,000 going up P&L account. Beyond 15,000 you credit to revaluation reserve. Same way in future if the value goes down. Now in past if it has already gone down, then same situation. So in past 15,000 gone down, now 10,000 gone down, you debit to P&L account. But in past, it was 15,000 up, now 10,000 down. Then you debit that 10,000 from that revaluation reserve, which already has the balance of 15,000. Okay. And if the value going down is more than that 15,000, then 15,000 you debit to revaluation reserve, excess amount you debit to profit and loss account. Rewind and listen to this explanation once again. Then only you read this. Complete thing will fit in your mind and it can be asked in MCQ. Now we just have to read it. I have already explained you the concept. Changes in the liability after the revaluation. Make it after. After the revaluation surplus or deficit previously recognized on an asset. After revaluation surplus or deficit previously recognized. A decrease in the liability should be credited to revaluation surplus, and in this case there is no revaluation surplus on that asset. The decrease in liability should be credited to statement of profit and loss account. Increase in liability should be debited to profit and loss account if revaluation surplus on that asset exists, then it should be debited to revaluation surplus account, and any excess than that revaluation surplus should be debited to statement of P&L account. In the event the decrease in liability exceeds the carrying amount, book value itself, then that would have been recognized. Had the asset been carried under the cost model, the excess should be recognized immediately in the statement of profit and loss. Measurement subsequent to initial recognition. Accounting policy. An entity may choose between the cost model and revaluation model. Just now I discussed, either you may go with the cost model, means you decide that you will record the asset in your books of accounts in all the years to come at cost less depreciation only. This is called cost model. Or you may choose the revaluation model, means you may say you want that the balance sheet shows true and fair value of your financial position. So you are going to revalue the asset every year and you are going to show the asset at fair value only and not at the cost minus depreciation. So you may choose, the entity is free. As per AS 10, the business entity is free either to choose the cost model or the revaluation model, but you cannot use, suppose plant and machinery. For machinery A, you cannot use cost model, and B, you cannot use revaluation model. If for machinery you are using cost models, then for machineries A, B, C, D, all machineries use cost model. If for building you are using revaluation model, then for building A, B, C, D, all buildings you have to use revaluation model only. However, the same policy must be applied to each entire class of PPE. As I discussed with you right now, all machinery is cost, all machinery is evaluation. Same model should be used for all the assets of that category. Classes include land and buildings, factory plant, aircraft, vehicles, office equipment, fixtures and fittings, etc. Cost model means cost, carry at cost less any accumulated depreciation and any accumulated impairment losses. So cost model is what? Cost minus depreciation. Every year you will show the asset in the asset side at cost minus depreciation. And revaluation model means you'll keep on revaluing it every year, and every year it may go up or it may go down. And I discussed earlier, if it goes up, what is to be done? If it goes down, what is to be done? Then you carry it at a revalued amount, being fair value on the date of revaluation less any subsequent accumulated depreciation and any accumulated impairment loss. To use this model, fair values must be readily measurable. Now revaluations. This I already discussed with you. Land and building. Market value is determined by appraisal normally undertaken by professionally qualified valuers. Who is going to do that professionally qualified value? You cannot determine on your own. I feel that the value of my building is 2 crore. You may feel 200 crores also, not allowed. A technical valuer should be there. He must value your asset and give you a certificate of that value. That value will only be taken in your books of accounts. Same way, plant and equipment. Fair value is usually the market value determined by appraisal, means evaluation. If there is no market value evidence of fair value, because items are of specialized nature or rarely sold, then fair value is estimated using depreciated replacement cost or an income approach. Means how much income you are going to derive from that in future, or how much depreciation replacement cost would take place if new asset is purchased. Frequency. How frequently should you revalue the assets? Revaluation must be made with sufficient regularity, means you should revalue them again and again, at least once in a year. If revaluation model is followed, revaluation minimum every year is compulsory. So revaluation must be made with sufficient regularity to ensure no material difference between carrying amount and fair value at the end of reporting period. Frequency depends on movement in fair values When fair values differ materially from the book value or carrying amount, of further evaluation is necessary. And items within a class may be revalued on rolling, means continuous basis within short period of time, provided revaluations are kept up to date. Accumulated depreciation is what would you do? At the date of revaluation, accumulated depreciation is either, now this is important, we'll be understanding it with the help of an example. Either the accumulated depreciation is restated proportionately with the change in gross carrying amount. Gross carrying amount means cost. Underline the word gross carrying amount, cost. So that the carrying amount means book value after revaluation equals its revalue amount. So either you restate it proportionately or you do elimination method. Elimination against gross carrying amount and the net amount restated as the revalued amount. We understand both these terms with the practical example so that it becomes clear. Second one, elimination against gross carrying amount, we understand first. The latter method, that is elimination against gross carrying amount or cost, is simpler and most commonly used for buildings. This can be asked in MCQ, mark it important. The elimination method is simpler and most commonly used for buildings. See this example. Cost is 1000, accumulated depreciation is 250 and book value is 750. Determine the accounting entries required to restate the carrying amount if revalued at rupees 1100 lakhs, underlined by elimination method. Now what is this elimination method? Look at it once again at the top. Elimination against the gross carrying amount means cost. What was the cost? 1000. Now how much is the cost? 1100. And then net amount restated as the revalued amount means, elimination means accumulated depreciation you will eliminate only. Okay, accumulated depreciation you will completely eliminate. So that cost of 1000 will become 1100 and book value will also become 1100. So what journal entry would you pass? That cost of 1000 is to be increased by 100 rupees to make it 1100. So cost account you will debit with 100. Accumulated depreciation as a credit balance. Accumulated depreciation as a credit balance. To remove it from the books of accounts, you reverse and debit it with 250. And the total surplus is 350. Why? Because the earlier book value was 750, now 1100. So your assets value has actually on the asset side increased by 350. That you credit to revaluation surplus account. This is which method? Elimination against gross carrying amount. What did I tell you? Gross carrying amount means cost. So cost of 1000 you revalue and make it 1100. You remove the accumulated depreciation from your books of accounts. Cost increases by 100, so you debit it by 100. Accumulated depreciation is a credit balance, to close it we reverse and debit by 250. And book value from 750 becomes 1100. So increase of 350 we credit to revaluation surplus account. First time increase you credit to revaluation surplus or revaluation reserve. Now let us understand that first point also, restated proportionately. Restated proportionately means cost, book value, carrying amount from 750 will become 1100. So you'll compare it. Book value 750 becomes 1100. So cost 1000 becomes how much? I repeat. Book value 750 becomes 1100. So cost 1000 becomes how much? 1000 into 1100 upon 750. Same way, book value 750 becomes 1100. So accumulated depreciation 250 becomes how much? 750, 1100, 250 how much? 250 into 1100 upon 750. This is called restated proportion. All the three are changed in the books of accounts. And all the three will change means in the books of accounts, cost you will increase, cost account debit. Accumulated depreciation you will increase, so accumulated depreciation account credit. Book value you will increase, so net book value will automatically get increased and credited to revaluation surplus. Look at it. Same example, cost 1000, accumulated depreciation 250, carrying amount 750. Now they say determine the accounting entries related to required to restate the carrying amount if revalued at 1100 lakhs, underlined by using proportionately restatement method. See, I explain you 750, 1100, 1000 how much? 1000 into 1100 upon 750, 1467. 750, 1100, 250 how much? 250 into 1100 upon 750, 367. And carrying amount automatically becomes 1100. Now, cost from 1000 becomes 1467, so it increases by 467. You will debit cost to 467. I already explained you. Depreciation from 250 becomes 367. It increases by 117. So accumulated depreciation you will credit with 117. And remaining you will credit to revaluation surplus 350 rupees. Okay. So I hope everyone is clear. When we apply the revaluation model, accumulated depreciation can be accounted in two ways: restated proportionately or completely eliminated. Completely eliminated means the cost itself will be increased. The first method, gross depreciation, will not appear in the books of accounts. Accumulated depreciation won't appear in the books of accounts. And second is, it will appear in cost, depreciation, book value. All the three will be restated or changed proportionately. Increase or decrease due to revaluation, I have already explained you. First time increase, upward revaluation reserve. First time increase, downward P&L debit. In future, if it revalues upward, and in past also upward, then again revaluation reserve. But in future, if it goes down, then to the extent it had gone up in past, you debit revaluation reserve. Excess amount you debit to P&L. In future, if it goes down, and in past also it has gone down, P&L. In future, if it goes down, but in past it had gone up, then to the extent it had gone up, you debit revaluation reserve excess, you debit to profit and loss account. This we already discussed. So on an asset by asset basis, increase should be credited directly to owner's interest under the heading of revaluation surplus in the balance sheet. However, a revaluation increase may be recognized in profit and loss to the extent it reverses a revaluation decrease of that asset that was previously recognized as an expense. So in past, if it is debited to P&L account, to that extent you will credit P&L account only. Extra amount you will credit to revaluation surplus. Now same way, decrease should be recognized as an expense in P&L account, debit to P&L account. However, a revaluation decrease must be charged directly against any related revaluation surplus to the extent it was covered by that surplus. In past, if it has resulted in surplus, then any decrease to that extent will be debited to revaluation reserve, extra amount debited to P&L account. The revaluation surplus may be transferred directly to retained earnings. Here underline retained earnings and write general reserve. When the surplus is realized, means finally when you sell the asset, dispose it off, then revaluation reserve account you will close and transfer to general reserve account. Example, on disposal of the asset or during the asset's remaining useful life. Now we come to the last topic in this chapter, depreciation. Depreciation I am discussing very much in brief because there is not much to understand. What you have been studying in past is sufficient. Straight line method is there, reducing balance method is there, formula is C minus S upon N, all that we have already studied. Land and buildings, these are separable assets and are separately accounted for even when they are acquired together. This is to be remembered. Underline this, separately accounted for even when they are acquired together. It can be asked in MCQs. Land normally has an unlimited useful life and therefore is not depreciated. So you'll separate it out. And buildings normally have a limited useful life and are depreciable assets. Where land also has a limited useful life, like landfill sites, mine quarries, because until the land vessel has that quarry or the metals in it, it has its value, otherwise not. So such lands are also to be depreciated because they have limited useful life. Three methods of depreciation are used: straight line method, a constant charge over useful life; diminishing balance method, decreasing charge over the useful life; and sum of units. This is in that land having limited life. The charge based on expected use or output. Now what are we supposed to do? We are supposed to review periodically the method we are using, straight line or diminishing or sum of units. And if significant, change method to reflect a change in pattern of consumption of future benefits. So if you find that changing the method from straight line and to diminishing or diminishing to straight line will result in better presentation of future benefits from that asset, then you change the method. Accounting for as a change, account for as a change in accounting estimate and adjust the depreciation charge for current and future period, means we have to adjust everything prospectively only. In past 5 years you have been doing by SLM, now you change to WDV, change it to WDV, and henceforth you start providing depreciation by WDV. Don't touch the past. Past, what has already happened has happened, forget it. Now you just change it to WDV and continue further, or vice versa. In past you have been following reducing balance method, now you change to straight line method. So from now onwards you start providing depreciation by straight line method. Past is not to be altered. Example on page 30, look at it, you have on page number 30 of your pamphlet the example. A limited depreciated a plant under two different methods as under straight line and WDV. In straight line method 3.9 every year, so total of 4 years is 15.6. In WDV the total of 4 years is 28.75. Fifth year 3.9 and 3.19. Required A limited followed WDV for first 4 years. In past it has followed WDV and 28.75 has been provided. And now decided to switch over to SLM, which has only 15.6 of past years. What would be the amount of resultant surplus or deficiency? Make it deficiency, not efficiency. DEFICIENCY, deficiency. 0. What did we say? Everything is to be changed prospectively. Don't touch the past. So no resulting surplus or deficit. Write down in your notebooks. As per AS10 revised, the depreciation method is to be changed prospectively, means now onwards, and does not result in any surplus or deficiency. Remaining part of your study material is removed from your syllabus, so we are not doing it. I repeat, after this point, whatever remains in your study material, CENVAT credit points are there, AS 16 points are there, some AS 28 points are there. They are removed from your syllabus because we are supposed to study only AS 10. So cancel that part from your study material. It is not to be studied. Last question 8 of your study material also cancel it. It is removed from your syllabus. So whatever is covered in your syllabus is already discussed over here. With this, the syllabus of HFA gets over. Okay, best of luck to everyone for your accounts. Bye everyone. Take care, and now see you in the next semester. Bye everyone. Take care.